Welcome to the Skilled MBA Finance Case Study Series, where we explore real-world ventures that embody financial innovation, strategic thinking, and long-term value creation. Huaneng Power International, a leading energy company in Asia, encountered a critical financial reporting challenge during a major corporate restructuring. At the center of the issue, how to account for business combinations under common control. Unlike standard mergers and acquisitions, business combinations within a group demand careful accounting judgment, especially when the entity is publicly listed on multiple global exchanges. Huaneng Power's listings in Shanghai, Hong Kong, and New York meant that its decision had to align with Chinese GAAP, IFRS, and US GAAP, all of which carry different interpretations and disclosure requirements. This case explores the implications of choosing between the purchase method and the pooling of interest method and how these choices affect reported earnings, investor perception, and regulatory compliance. It underscores the intersection of corporate governance, accounting policy, and strategic transparency in global capital markets. Huaneng's experience highlights the importance of consistency, cross-border alignment, and the role of financial reporting in preserving investor trust during complex reorganizations. Huaneng Power International, a major player in Asia's energy sector, navigates complex regulatory landscapes across Shanghai, Hong Kong, and New York stock exchanges. The company confronted a pivotal accounting challenge, determining the appropriate method for business combinations under common control during corporate restructuring, a decision crucial for accurate financial reporting and compliance. Business combinations under common control, BCUCC, involve transfers between entities under the same controlling party, like a parent company and its subsidiaries. These internal restructurings differ from typical acquisitions, necessitating unique accounting approaches. Their internal nature demands specific financial reporting treatments, highlighting the complexity and importance of accurate accounting in such scenarios. International financial reporting standards lack specific guidance for business combinations under common control, leading to a policy choice for companies. Entities must choose between the acquisition method, aligning with International Financial Reporting Standards 3, or the predecessor method, using historical book values. This decision requires significant professional judgment to reflect the economic reality accurately. The acquisition method records assets and liabilities at fair value, recognizing goodwill and potentially lowering return on assets. It treats transactions as arm's-length acquisitions, requiring complex valuations. Conversely, the predecessor method uses historical book values, maintaining continuity and historical metrics, with no goodwill recognition. Each approach significantly impacts financial statements and investor perceptions. HPI deviated from industry norms by choosing the acquisition method under International Financial Reporting Standards, unlike most Chinese companies that prefer the predecessor method. This strategic decision led to dual reporting, with HPI using the predecessor method for People's Republic of China generally accepted accounting principles, resulting in two distinct financial statements. This reflects a strategic managerial choice, not just a technical accounting decision. HPI's adoption of the acquisition method led to higher reported assets and equity. However, this approach also resulted in lower return on assets and net income, primarily due to increased depreciation from revalued assets. These financial impacts highlight the trade-offs between asset valuation and profitability metrics. HPI's decision to adopt fair value accounting enhances its appeal to international investors, aligning with developed market practices. This approach strengthens the balance sheet, potentially improving debt covenants and borrowing capacity. Domestically, using the predecessor method maintains positive regulatory relationships, while strategically differentiating HPI from competitors, signaling sophisticated governance to international stakeholders. Analysts and investors encounter challenges comparing HPI with peers due to differing accounting methods. Sophisticated adjustments are necessary to normalize performance metrics. Profitability and efficiency interpretations vary, requiring reconciliation between international financial reporting standards and People's Republic of China, generally accepted accounting principles figures. This dual reporting system complicates evaluating HPI's performance against industry benchmarks. HPI faced the challenge of meeting diverse reporting standards across Shanghai, Hong Kong, and New York exchanges. This required auditor approval of dual accounting methods, demanding thorough justification. Enhanced disclosure was crucial to clarify the rationale behind these approaches and reconcile financial impacts, ensuring transparency and compliance with multi-exchange regulations. HPI's situation underscores a critical gap in international financial reporting standards, allowing varied accounting treatments for similar transactions, challenging global accounting consistency. The International Accounting Standards Board has acknowledged this and is actively researching business combinations under common control accounting to provide clearer guidance, aiming for improved international harmonization. Companies must exercise professional judgment in selecting accounting policies where standards lack guidance. Cross-border financial reporting presents challenges due to varying accounting regimes. Strategic accounting decisions can align with corporate objectives, influencing investor perceptions and corporate messaging in global markets. Consider whether the acquisition or predecessor method better captures HPI's restructuring. Evaluate how HPI's varied methods impact transparency and strategic benefits. Analyze how users should adjust comparisons with peers. Debate if regulators should limit policy choices for business combinations under common control, and what disclosures best serve investors. Examine cultural influences on policy selection in emerging markets. Advanced financial accounting courses benefit from exploring policy choice and professional judgment, especially in applying international financial reporting standards in complex scenarios. International finance courses examine cross-border reporting challenges and strategic accounting dimensions. Corporate governance courses analyze how accounting policy decisions reflect governance priorities and stakeholder communication strategies, enhancing understanding of financial transparency and strategic management. For further inquiries or access to additional resources on finance, accounting, and strategic management, reach out via mobile at +91-8 7553-00795 or email support@skilledmba.com. Explore more case studies and educational materials by visiting our website at https://skilledmba.com.